Monetary policy part 1. Today we're going to focus on the tools of monetary policy. What is monetary policy? And then the graphs that show easy money and tight money policy. So let's first start off with the questions. So you're going to want to pause it here in a second. I'll tell you when to pause. I'll say the word. First one, define monetary policy. Then what are the 3 tools of monetary policy? And then again, what are the 2 problems facing economics? And what is easy money? And then it's called easy money policy and tight money policy. And then draw and label the easy money and tight money graphs. Definition of monetary policy. Oops, sorry about that. Go back, pause right here. Okay, now let's go to the definition. The definition of monetary policy is the government regulation of the money supply by Federal Reserve Board, the Fed, adjusting interest rates to increase or decrease inflation and control the money supply. So that's the definition of monetary policy. The 2 problems facing the economy, again, are inflation and recession. And so with monetary policy, here's the 3 tools: discount rates, open market operations, and reserve requirements. And monetary policy with recession, you're going to lower discount rates, which is basically interest rates. And you want the lower the interest rate, the more people want to borrow money. The more money they want to borrow, the more money in the economy. And then open market operations is the government buying and selling bonds. And when the government buys bonds from people, it basically is putting money back into the population. You give me the bond, I give you cash, there's money in circulation. And reserve requirements are member banks of the Fed that they are required by the government to keep in their safe. When you make a deposit, let's say of $100, and there's a 10% reserve requirement, what that is saying is that the bank must keep 10% of that in the vault, and they can loan out the other 90%. So the lower the reserve requirement, the more money banks have to loan out to people, more money in circulation. So that's what that means, and this is titled easy money policy. During inflation, discount rates or interest rates are raised because you're trying to slow the money supply down and slow the people's ability to want to get loans. You're in open market operations, you are now selling bonds. What this has to do with is you're trying to take money out of the population. So when I sell a bond to you, you have the cash, I sell you the bond, you give me the cash, I give you the bond, therefore I'm taking money out of the population. And reserve requirements, the higher the reserve requirement, the less money there is going to be for the bank to loan out. If you give me $100 on the bank and a 50% reserve requirement, I got to keep 50, and then I can only loan out the other 50. This is titled tight money policy. You're trying to slow down the economy, slow down the supply of money, trying to speed up the economy and increase the supply of money. This is easy money policy again. It looks the exact same as fiscal policy. What you're doing is you're in a recession, you're trying to get back here. And tight money policy is this. You're going to see 2 different graphs. These are called the whole economy. These 2 are. Okay. There's also going to be a money market graph when it deals with the supply of money. It looks completely different from these. I don't want to confuse you today, so I won't give you those today. Okay, so go back to the questions. You should be able to answer all those questions. Have a great rest of your day. See you guys tomorrow.